Hey everyone. Hopefully I have the lighting just right and it shouldn't be some weird shadows changing here and there. But today we're going to be talking about I bonds. Now I bonds are very interesting because for the longest time no one ever talked about them, and all of a sudden it's the hot topic because I bonds are related to inflation, and we all know inflation is pretty terrible these days, which brings up a very important question. What is a good investment asset when inflation is sky high? Now, I bonds are safe investments through the government. Basically, just like any other bond, you're lending the government some money and they're promising to pay you back the principal, which is the original amount, plus interest. So money that they're paying you for lending them X amount. The interest is special because it's tied to inflation. Now, this is important to keep in mind because remember, inflation means there's a reduction in your buying power. The cost of goods and services will increase in price. So in other words, a dollar today is worth less in the future. You see this right now with gas, you see this right now with food, rent, you see this across the board right now. Everything's just increasing in prices, and that's just inflation happening in real time and much more quickly than it has in the past. Another important thing from I bonds that there is no state or local tax. There's only federal income tax. So the interest is only taxed on a federal level. It's a great tool for retirement because you avoid diminishing your purchasing power without taking a lot of risk, because generally speaking, the US government does pay back their bonds. But like all investments, it sounds too good to be true. Well, there are some limitations. The first one being is that you're only able to purchase $10,000 of I bonds every year. And on top of that, I bonds must be held for a minimum of 1 year. And if you decide to withdraw I bonds or cash it out before 5-year period, then you're going to take a 3-month penalty in interest. And specifically, you're losing the previous 3 months of interest. Still not too bad when you think about the limitations. That's still $10,000 that you can basically use to fight off inflation, and that's a good chunk of change. Some savvy folks actually buy I bonds every year and sort of build a ladder, right? So they buy every year so that on the 5th year or the 6th year, they can withdraw the original $10,000 without that penalty. Again, great tool for retirement. So if you are close to retirement or maybe in FIRE, it's definitely something to take a look into. If you have more questions, don't worry, because all I did was read off the site, the official site for I bonds, which you can find in the description below, and you'll see more information there. I know I showed you the site. The site looks a little sketchy, and that's because it's built a long time ago and it really hasn't been updated from a UI perspective. Based on what I'm seeing, it should be pretty straightforward to use. If you are looking to buy I bonds, then the first thing you want to do is make sure that you qualify. You have to meet certain requirements to buy I bonds. And as long as you meet those requirements, you should be good to go. Then the next step is deciding if you want electronic or paper bonds. For most of us, we probably want to go for electronic because you can also buy more I bonds. Paper I bonds, you can only buy up to $5,000, while electronic I bonds, you can buy up to $10,000. So that's a huge difference. So definitely consider going with electronic. Now the first step here is really just to make an account. Like any brokerage site or any place where you're trying to make investments, you make an account and you go about buying it. And maybe the UI isn't, not the fanciest, not the most up to date. Luckily for us, they do have a guided tour for us to see basically exactly step by step what to do, including screenshots and so on. So it shouldn't be too crazy. So why is this such a hot topic? I mentioned it before, but inflation is basically sky high, which in turn means that I bonds are also sky high, because remember, I bonds are tied to inflation. And we've all seen the headlines, but you'll also notice that along those headlines, we also see I bond headlines saying that they're almost at a record high. The current rate for I bonds is 7.12% or 3.56% if you think about the rate only applying for 6 months. Once May comes along, there will be a new rate being calculated from the previous data. So the I bond rate only applies for 6 months when you purchase it, and it gets recalculated twice a year, basically. So we don't really know what the rate will look like in May, but we do have analysts that are saying that they're predicting the rates are as high as 9.62% or 4.81% when you think about a 6-month period. Is this true? Maybe, but hard to say until they actually run the numbers. We do know that inflation has continued to go up from our data, and hopefully it will taper off based on what the Fed is doing in terms of increasing interest rates. And now it's important to call out that these rates are crazy, the I bond rates, and they seemingly are much higher than the average return on the S&P 500, which is the metric for investments that most people use. The S&P 500 usually hangs around 7%, accounting for inflation. So that's why it's such a hot topic, because it's pretty amazing, and many folks are jumping on this opportunity to basically make more money than the stock market on average. A lot of folks ask me, are you getting I bonds, Alan? What are I bonds? Now, I'm not getting I bonds because my cash position is very small, or in other words, the amount of money I have in liquid cash, in savings and checkings, is pretty small, and it's very lean. Basically, it encompasses just my emergency fund. The rest of my money is already invested in the stock market and will continue to be invested in the stock market. The reason I don't just sell my investment assets and just invest into I bonds, even though the rates of 7.12% or even 9.62% are super high compared to the average 7% in the stock market and S&P 500, is because the long-term capital gains tax rate comes out to 15% for us. Right? So in other words, I would be paying more taxes if I withdraw the cash and put it into an I bond than just leaving it in the stock market. And I completely understand the concern of that, because the stock market has been going sideways and even down so far this year, and maybe it'll change, maybe it won't change. I don't have a crystal ball, but I can say that historically, I bonds don't make more money than the S&P 500, which makes sense because I bonds are tied to inflation. Inflation, for the most part, the Federal Reserve tries to aim for 2 to 3%. And since S&P 500 on average returns 7%, likely S&P 500 will win out in the end and it will make more money. But maybe this year, right? Specifically this year, I bonds will make you more money than in the stock market if you invest in the S&P 500. But long term, that's likely not true. Just because if inflation continues to be high, that's a different concern altogether. And you could have as much I bonds as you want, but there's still a $10,000 cap on it. So if inflation continues to be high, we're going to see issues in other areas as well, right? Folks are not going to be able to retire, and it's completely different. I'm hoping that that's not the problem, because I bonds will not fix that issue for you. It might make it hurt less if that's the issue, but it's not going to fix it. And it might signify that we have large economic problems at play that I bonds can't solve. Now, I'm not saying that I'll never get I bonds. I'm not saying that at all. Just similar to my reasoning for why I don't have bonds right now, I'm planning to get I bonds once I either have a large cash position, right? So when I'm closer to FIRE, closer to retirement, right? Maybe 5 years out. Or, if you are trying to buy a home, if you're a couple years out from buying a home, it makes sense to put that money into a safe investment like an I bond versus investing with S&P 500, where you might possibly lose that money. If you're planning to use money within the next few years and you're saving a lot of cash in your savings account, maybe it'll make more sense to put money into an I bond versus leaving it in a savings account, where it will make you less money. Even if it's high yield, still less money, or putting in S&P 500 where you potentially might lose that money when you do need it a few years down the line. Hopefully that helped you out. You thought about I bonds, you have a better idea about whether you want to get them or not. Personally, I'm not getting them, but it might fit your financial situation depending on where you're coming from. And with that, I wish you the best of luck. And let me know how buying I bonds go, because it looks a little sketchy, but from what I'm told, the website works just fine. All right, I'll see you in the next one.